Good evening, it's Adil bringing you a review of the US markets from an intermarket analysis perspective. Okie dokie, let's try and decipher as to what's happening with regards to this market, because there is a divergence between European, Asian and obviously US markets right now. Okay, right, basically the highlight of today is the CPI data. Okay, that's basically the highlight of the day. As forexlive.com, I mean, if I just bring up the news at forexlive.com, economic data due from Japan. That's from Japan. Sorry, let me just ignore that. Let me just get the correct link. 1 second. US dollar roars. Here we go. Okay, so this is the correct link. So basically, it was all about this single figure here. Here we go. US January real weekly wages plus 1.2%. Everything else was irrelevant. Okay, the jobless claims, obviously we already know, came out worse than expected, so obviously more individuals claiming job seekers, obviously that's negative for the dollar. We had stronger durable goods orders, obviously that's positive for the dollar. Okay, and everything else really I think it's irrelevant. Yes, we did have concerns with regards to Greece needing more than the expected. I think it was 10 billion or 20 billion. Irrelevant, really. It needs almost in excess of 30 billion euros in order to survive, etc., etc. Then obviously we had a few hawks that were obviously on tap and certainly discussing the data as it came along. And it certainly seems like the Fed is certainly trying to psychologically send out signals to get everybody prepared with regards to a rate hike, basically. Even though they don't want to commit, and obviously the actual minutes from the FOMC, a lot of individuals. I mean, it's interesting, isn't it? I mean, people will read what they want to read. People will think what they want to think. So they already have preconceived judgments, and everybody's so ingrained within everybody now that the Fed will hold, Fed will remain patient, etc., etc. And I think that's the psychological game that Miss Yellen's trying to play. She's slowly trying to get wean everybody off that mentality, and obviously get everybody accepting the fact that we are going to be raising rates, and it is going to be a expansionary monetary policy. It's no longer dovish; it's going to be hawkish. So basically, it's going to be very interesting. Anyway, either way, it's all about inflation and real inflation and wage inflation. Okay, so if real weekly wages are rising, then obviously it's going to feed through to inflation, and that's the argument that Miss Yellen has been using, because the economic data itself overall, especially in terms of jobs, has certainly been coming through. Once you get wage inflation, that generally is a trigger to stop this global rout of inflation that's coming. Okay, if every central bank around the world, I mean, you had Turkey and Israel obviously cutting this week as well. Everybody wants to cut rates, race to the bottom. Everybody's trying to obviously devalue their currencies. That's going to create inflation, even though there's a temporary obviously blip with regards to commodities, with oil prices making new lows again at $48. Either way, that's only temporary. So once that's out of the way, that's fed through the system, then you are going to get inflation, hyperinflation. And if a central bank doesn't start to raise rates and fight off that inflation in advance, then it's a zero-sum game. Somebody is going to absorb that, and obviously that's going to create havoc and turmoil within that economy. So the best way to do that is obviously to fight that in advance. Okay, so that's basically where we stand. So the Fed wants to stay ahead of the curve, and that's why it's very important for them to fight in advance. And one of the ways of fighting it obviously is to psychologically prepare the markets for that. So when the inevitable does come, everybody is accepting, and there's no knee-jerk reaction. Okay, that's just generally how it works. If I was a central banker, that's how I'd operate as well. So respect to Yellen. Okay, right. Over and done with regards to fundamentals now. I know a lot of people out there. I mean, a lot of traders out there don't actually even adhere to or even attempt to understand fundamentals, because they call it noise and they claim it doesn't move markets. That's totally irrelevant. Sorry, not irrelevant, but that's totally incorrect. The reason why I say it's incorrect is because I expected this right shoulder to hold in the S&P 500, even though the Asian markets were higher, even though the European markets were higher because of a weaker euro, if you want to interpret as such. Even I have yet to know why the European markets rallied to such an extent, which really is quite baffling, really, given the fact that you've got Greece needing a bigger bailout, and obviously the Germans giving anti-QE speeches in Europe, and also with regards to the 22 German votes for against a bailout. So that certainly seems to be growing, and there's a lot of unease. And there was an article warning in the Telegraph. If you look at the Telegraph now, there's an article warning or warning the Greeks from a German perspective with regards to behaving themselves when it comes to obviously seeking this bailout and using the correct terminology. And let me just find this article. It's quite interesting. Bear with me. Okay, here we go. So Germans say 9 to bailout. I mean, here's the article, and this is why it's quite baffling. Germans say 9 to Greek bailout deal. No more billions for greedy Greeks. Germany's biggest selling mass market newspaper has said. Okay, so as you know, I mean, if that's the biggest newspaper in Germany and they're stating 9, then what do you think will happen later on? Okay, so Germany's biggest selling mass market newspaper said 9 to new bailout deal agreed by the Eurozone for Greece. Bild has launched a new campaign against the deal, printing a massive 9 across the entire inside page, encouraging readers to take selfies or holding the page up and send them in for publication. No more billions for greedy Greeks, etc. With a daily circulation of 2.5 million, Bild is hugely influential in German society, though it is printed in broadsheet format, etc. Selfies of readers, blah 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 blah. Okay, so that's not exactly something that you want to be reading in terms of a Eurozone cohesive strategy, etc., etc. So there's certainly a lot of games to be played. Okay, this game is not over. There's many more games that are going to be played, and that, as you can see, with regards to the euro, a total flush in the euro. Now, I was long the euro twice today, and I got stopped out. And one of the reasons why is because one of my, I mean, again, when it comes to mentors, what is a mentor? A mentor is a teacher whom you learn from on a daily basis. Okay, and one of my mentors, who I consider, just like Anna Cooling, I consider her my mentor. I also consider Kathy Leon, and I hold her in great esteem. Okay. And I learn from her on a daily basis. And one of the reasons that I was obviously going long the euro on this dip is because of her analysis is very comprehensive. I mean, I can do my analysis from a fundamental perspective. I can read between the lines, but it gets to a point where you have to rely on other reputable, respectable analysts, stroke traders. Okay, and one of the traders that I respect obviously is Anna Cooling, and analysts Anna Cooling, also with regards to fundamentals, specifically Kathy Leon. And her article with regards to 5 reasons for a euro short squeeze were very, very powerful from a fundamental perspective. Okay, very, very powerful. Adding the fact that you had a inverted head and shoulders formation. If you look at your 4-hour chart on the Euro USD, a beautiful inverted head and shoulders formation. Adding the fundamental reasons which we've just discussed, and off we go to the races. So Yellen in no rush to raise rates, ECB presidential Draghi, Brexit no longer an immediate risk, German US 10-year real spread moves higher, extreme short positions, etc., etc. So number one, Brexit no longer an immediate risk. Obviously that was cast into doubt with regards to the bailout being much higher than expected, and obviously German newspaper, etc. ECB President Draghi sees signs of confidence in real economy, which, yes, that's correct. He certainly talked about green shoots. Yellen in no, and obviously the stronger German data that came out today, obviously employment data and obviously confidence data as well. Yellen in no rush to raise rates. Yes and no. I mean, this one is debatable. I'll have to debate with regards to Kathy on this one, because she did remain neutral, although she did say it's data dependent. And obviously data dependent with regards to today, real wages increasing, that's data dependent, therefore you raise rates, and obviously the markets tanked in the opposite direction. And those of you that know, I am swing long the Euro USD. I still expect, and the reason why I maintain that swing long position, although it is close to being stopped out at 1.116, basically the reason why I kept that position is because I do expect, yes, I believe the wage inflation data certainly has been factored into a certain, well, obviously a large extent now, because the euro is down quite substantially. It's almost 160 pips against me at the moment. But the fact that the Brexit is no longer a immediate risk, yes, it does remain a risk, and yes, it has factored that in as well to a large extent. but I do believe there are a hell of a lot of shorts in there. German 10-year yield, that's certainly a strong argument. Okay, so, and obviously President Draghi. So if 3 or 4 of those the 5 arguments were obviously nullified, then obviously I would have switched my bias. Also, with regards to anti-QE comments from Mr. Wiedmann today, and also one of the Bundesbank members, I forgot the name now, they were very hawkish. They were talking about the end of QE sooner than expected, and also they were basically downplaying negative, or very negative, downplaying negative interest rates, and also discussing the fact that that's leading to a bubble, and that we have to obviously increase interest rates. From a German economy perspective, yes, that's certainly true. Bundesbank certainly needs to start raising interest rates, because unemployment obviously is below 5% now, I think, if I can recollect, and that obviously is going to lead to inflation down the road. So it's going to be the economic model that fits Germany, or the economic model that fits Europe. So again, that's certainly something that needs to be taken into discussion or consideration. So as you can see, inverted head and shoulders formation on the euro has failed. Now the euro itself has become the risk barometer now. Okay, so before you had the USD JPY certainly is to a large extent a risk barometer, but today that obviously wasn't the case. I mean, USD JPY screamed to 119.5, and the markets obviously were not screaming higher at all. The S&P wasn't screaming higher. The Euro JPY sold off quite substantially, down almost 200 pips or 250 pips, and yet the S&P 500 wasn't down in proportion. So can you see the divergence between the USD JPY and Euro JPY today? Hence the reason why the correlation between the S&P 500 and the yen pairs is somewhat distorted. Again, my explanation of US markets being distorted. Okay, so if you look at the S&P 500, I mean, if I just bring up a chart of the USD JPY, again, this is all part of intermarket analysis. These are all the variables that I'm looking at on a daily basis and observing consistently and constantly. Okay, so as you can see, Euro JPY flushes, okay, from 135.50 all the way down to 133, quite a substantial flush. Okay, then you have the USD JPY. So if I just bring up the USD JPY, where are you, USD JPY? There you are. Okay, so USD JPY, if I just bring up a 10-minute chart of that, and you can see it's going in the opposite direction. Yes, because obviously real wage inflation, etc., moves higher. Obviously dollar higher, yen lower, etc. So USD JPY higher. So that's basically what you're observing there. So the Euro JPY was flushing. Why? Because of the obviously Greece deal. That's the only thing that you can attribute it to, because overall the European economic data was very strong today, and also anti-QE comments as well. So again, the whole sell-off from the European perspective is all regards to the 9-camp vote, or the 9-camp proper I don't know, I won't call it propaganda, but basically the truth, really. I mean, the Germans don't want to be paying for the mistakes of the Greeks, nor do they want to be paying for the mistakes of anybody else. So that's something that certainly needs to be taken into consideration and respected as well. Okay, so these are all factors that are very important in terms of understanding the market status. Now, if you look at the S&P 500, now ask yourself, has the S&P 500 on a 10-minute chart, who has it followed the most? I mean, you clearly, from my perspective, it's following the Euro JPY and Euro USD. So if you bring up the Euro JPY, that's obviously down, and you can see the S&P 500 is down. If you bring up the chart, the Euro USD, you can clearly see that's down. If I go to a 10-minute chart and explain that to you, and that's exactly what's happened to the S&P 500. So ask yourself, what's the correlation to? The correlation to is what? Is obviously to the euro. Okay, so that basically is the risk barometer at this very moment in time. Now you have to ask yourself this question. You have a H&S formation on the S&P 500. Now you've got a right shoulder that's gone in. You had this rising contracting wedge pattern. Obviously we've broken out of that key trend line and that wedge pattern now, and we are looking to potentially retest this 2100 level, if not obviously go below to 2085. Okay, we do have another support around here at around 2090, so that certainly needs to be respected as well. Okay, if you bring up the 10-minute chart on the S&P 500, you can see that we do have a potential. I mean, we have broken out that symmetrical wedge, so I'll leave the upper trend line for now, get rid of the lower one. Okay, and that's basically the trend line that we are into at this very moment in time. This level has held to a certain extent, but now no longer needed, so I'll get rid of this. Okay, obviously these are all support levels and previous resistance equals support, You obviously have held this double bottom for now, so I have to respect that. And we'll see exactly where this market opens up tomorrow and how it trades overnight. So the Asian session is going to be quite crucial from my perspective, and we'll see exactly how the market obviously behaves from there on in. Okay, so this is basically where. Okay, this is basically where we are. Okay, so that's your S&P 500, and that's how it's trading at this very moment in time. You do have levels below, no unfilled gaps really, other than this gap down here at 2070, but it's very hard for the markets to close at this very moment in time. If I go to the daily chart of the S&P 500, what am I seeing? I'm seeing a doji and doji again, so really it's exhaustion here now. Is there any particular trend line or any pattern that I can observe? Not really, nothing. I can't see anything at all. Nothing whatsoever. I can't see anything at this very moment in time. Okay, if I bring up a weekly chart, am I seeing anything here at all I can see is a doji, so potential exhaustion on the weekly chart thus far, so certainly a neutral day. 60-minute chart at the moment, yep, you are seeing some buying coming with extra volume, so again we'll see exactly how this plays out. The upper body is around 2113, so that's going to be a key resistance level. Using your Fibonacci retracement here as well, take the pivot high, take it to the neckline, provided we remain below the 61.75%. That's basically remains bearish. So below 2115, 2114, S&P 500 is bearish, and we're going to be testing 2100, 2019, and obviously 2080 on the downside. Okay. Now, how do we corroborate the actual movement in the S&P 500, and how do I know the S&P 500 is bearish? Very simple. Well, I wouldn't say simple because that's patronizing, but it's the Russell 2000. It's very important for you to look at the Russell and see exactly what the Russell's telling you. Now, you've got a key trendline Russell that's been respected thus far. Can you see the pivot high? Connect it to this pivot high, and obviously gives you this pivot high. And the Russell hasn't actually moved higher at all with the S&P. I mean, you can clearly see it's lagging, and certainly is holding this resistance level here. Okay, so again, certainly not a bullish or a positive sign. If I go to a 60-minute chart of the Russell, all I can see here at this very moment in time, I mean, you have this trend line, that's fine, extend that across. Okay, and basically looking at resistance here, and at this very moment in time, so really nothing at all, to be honest with you. I mean, that's basically what we're observing. Obviously you've had this H&S formation here, potential move here. I mean, you can't argue that one has a H&S here. There's your left shoulder, your head obviously has been in, you're looking at a right shoulder, and obviously down you go. But from my perspective, again, like I said, you've not made a higher high, so it's nowhere near the S&P 500. So this certainly is exercising or displaying a very bearish pattern. Okay, and again you can clearly see horizontal resistance here as well. So certainly lagging. Okay, so if you look at Russell 3000 as well, let's just see if we can get any sort of pick up any clues from there as well. One of another index is that mana cooling, and other intermarket analysis participants observe as well. Daily chart, as you can see, is a doji. 60-minute candle, you clearly see it's very similar to the S&P 500. Okay, very similar to the S&P 500. This is quite important. This, folks, is you have this H&S formation. So you've got your left shoulder here, you've got the head that's in here, and obviously the market's consolidating within the red candle. Okay, so let's go to a 10-minute chart now. Let's quickly toggle and flip over. Again, very similar to the S&P 500, the Russell 3000. Obviously you've got a potential double bottom here. Okay, so we'll see exactly how the market pivots from there. The market held the opening gap, so you can see here market held this level or this resistance zone here, and it certainly seems to be struggling at this very moment in time. So let's get this organized, bear with me. Okay, so this is where the market opened here, market closed the day before, so failed to pivot or move any higher. Okay, so again, warning sign, okay, clear warning sign. And like I said, H&S formation on the 60-minute chart with a doji candle on a daily chart. Another index I generally tend to follow is the Wilshire as well. This is quite an important index, and certainly again it's finding resistance. Doji candle, as you can see, 60-minute chart, very similar to the S&P 500, and confirming the pattern. So again, when you have multiple indices confirming the same pattern, again it's very bearish. Left shoulder, you've got your head in here, creating the right shoulder, then obviously down you go. Okay, and the next test is going to be a 21 600 level. Now the reason why the markets are going to sell off is mainly because of the wage inflation. So it's all about the US dollar. So if I bring up the chart of the US dollar, that's the yen. Let me just ignore that for a second. There we go. US dollar. Obviously, you've seen the daily chart, bullish engulfing candle. We attempted to break lower, given the fact that everybody's interpreting Miss Yellen's FOMC minutes as dovish. Obviously, that's not the case, as you all know now, and the markets are obviously confirming that. So if we do break up below here, then obviously we need to confirm that with a fundamental catalyst. So i.e., if we get any more inflation data or any individual obviously states otherwise. Okay, so understood. Okay, so that's very, very important. So daily chart, where we go, 60-minute chart. Okay, 60-minute chart. Obviously, we bounced off this pivot support here. The only variable that you must observe is this variable pair here. So you've got this unfilled gap up here. Given the fact that obviously the real wage inflation, or interpreted as inflation, obviously real inflation, is basically, it's all about that gap. So whether that can sustain the move higher. So any geopolitical event would cause a sell-off, cause a sell-off in obviously your euro, Aussie, sterling, etc. And if it's versus the dollar, and obviously the dollar will certainly catch a bid. So it's all about the risk currencies and how they interpret. Now, given the fact that the oil price made a new low, that isn't exactly helpful for commodity currencies or the euro either. So watch out for that, and obviously given the fact that you had Greece as well, so certainly take that into consideration. Okay, it's very, very important to do that. Okay, so watch out for that unfilled gap above, and the fundamental catalyst is certainly there. Okay, now let's have a look at the Dow, or the Dow Transports. Now this is very important. This confirms the bearish view on equities, given the fact that the Dow Transports has failed to really propel higher, and obviously it's confirmed bearishness, or confirmed the negative bias from that perspective. Okay, so that's quite important. That's going to be very interesting as well. Okay, right. Okay, so we're out now. Okay, so we are now in this zone here. Okay, on the Dow Transportation. So again, very bearish. On the 60-minute chart, again, is indicating to me weakness. Why is it indicating weakness? Because it's indicating a potential for a H&S formation. So you've got the left shoulder in now, you've got your head obviously in, you're looking for a potential little mini bounce, and obviously down we go. Now let's get this confirmed via the Dow. Let's have a look at the Dow Jones. That was the Dow Transports. If I go to a daily chart of the Dow, yes, we have broken above, but if there's no confirmation from the actual Dow Transportation, then I consider that as being a fake out. So again, be wary of that fake out. And again, you can see a doji candle exhaustion, no real commitment there at all. Okay, 60-minute chart, again exhaustion. We are trading inside. So again, I'm going to give it the benefit of the doubt for now. Obviously we had a failed H&S, so we obviously moved higher, and I can't really see anything other than this pattern here with regards to the Dow. From my perspective, again, you do have an argument here for a potential H&S. If I go to a 10-minute, I should be able to see that better, and yes, you can. So you've got this H&S formation, so I would be very, very wary. So you've got the head here, and obviously a potential bounce here, and then obviously down we go. So that's going to be very interesting with regards to the price action, and something that I'll be certainly keeping an eye on with regards to the Dow itself. It clearly shows that you've broken out of this wedge. Can you see this wedge type pattern that I'm just drawing right now? We've obviously broken out this long rising contracting wedge, very similar to the S&P 500 by the way, and very, very similar to the FTSE pattern. If I bring up the FTSE 100, what pattern do you see there? Rising contracting wedge. Same type of pattern you're seeing, which is quite interesting, I think. Okay, very interesting. And also the Dow, can you see rising contracting wedge and then H&S formation? This is all signs of exhaustion and a potential reversal on the cards. Okay, right, let's go to the Nasdaq now. Okay, let's have a look at the Nasdaq. Okay, so Nasdaq itself failed the H&S formation on the 10-minute chart. I'll go into that in a second. Certainly a thrust higher, so even though you attempt to your best at printing some sort of negative bias here, it's very hard on a daily chart. Very, very hard for me to do that. The weekly chart, obviously nobody wants to argue with regards to that being bullish. 60-minute chart, all my only argument here would be that yes, we've broken out this downward or upwards rising channel. Obviously we've broken out, we've tested, etc., and it's all about whether or not the argument is, initially I did expect the right shoulder and obviously break lower, but for now it's let's just get rid of the channel, and it's all about that double top resistance. Obviously if we can hold this resistance here at the 4460 level, then we can go back, potentially create this head at 4 and a neckline at 4430, then obviously we'll see exactly what happens there. Obviously if you go past 4460, then the bearish argument is certainly out of the equation, and we continue to make new highs. Okay, so basically that's where we find ourselves. If we just draw in your horizontal resistance level up here, that's basically where we are. Okay, that's the only thing I can certainly argue for, and obviously if you do break higher, then you're looking at 4475, 4480 on the upside. Now let's just confirm that, and let's see if that move is actually confirmed with the rest of the components. So the semicons certainly has broken higher, consolidated higher, held higher. You have to respect that. Okay, the biotechs are not confirming that. You've got a potential hanging man candlestick, so again indicating exhaustion. So this one of them is Pinocchio. Which one? Okay, is the Nasdaq true and the semicons true? And given the fact that you have China news and Apple news, so given the fact that China has dropped Apple or dropped any US company and technological company in terms of government grants because of the NSA scandal and the Snowden scandal, the leaks with regards to then tampering US computers or American made components have certain listening devices in there, and or the ability to obviously steal that data or invade the privacy of that individual, utilize that machine, etc., etc. So state secrets and so on and so forth. So certainly used for espionage, and that's not a good sign. Okay, so loss of revenue there. Also with regards to this Apple Watch, there's a lot of hoo-ha, but there's a lot of negativity surrounding this Apple Watch. One of the reasons why I closed my Nasdaq short, I was short around the 53, 54 level average. I actually got out for plus 10 before the Nasdaq obviously swung right back up again. So that's one of the reasons why. And obviously given the fact that net neutrality as well, net neutrality was certainly hurting the technological stocks. So obviously that got voted in today, wasn't voted against, so that's certainly some uncertainty and some fear taken away with regards to the Nasdaq. But we have the Apple stock certainly priced for perfection, and given the fact that individuals started to sell off. Now other technological stocks as well, such as Netflix for example, Twitter for example, Google for example, I mean even Amazon to a certain extent, all putting in potential bearish into resistance or bearish patterns. So that certainly needs to be studied and looked at if you are a trader with regards to the Nasdaq. Okay, again, very, very interesting given the fact that the S&P 500 is confirming weakness, the Dow's confirming weakness, and the biotech certainly aren't playing ball. Okay, from my perspective, so it's very interesting, and we'll see exactly how this transpires. Again, it's all about news with regards to Greece, any breakdown or any anti-QE comments or any pro rate hike comments, etc. That will dictate as well. So I think the markets are priced for perfection. We haven't had a correction yet, given the fact that the real wage component today started to rise, and obviously leads to talk of a rate rise. That certainly isn't factored into the market. Okay, so I think from that component, from that perspective, provided the Asian markets are weak, provided we can get one or two fundamental catalysts, my certain trade at present is certainly on to the bearish side. And as subscribers know, I'm already short the FTSE going into tomorrow, given the fact that the oil price dropped to 48, which is obviously a bearish signal. Okay, and obviously H&S formation on the S&P 500, as you've already seen, and that certainly seems to be the highlight of the next 24 hours. Okay, folks, so hope my insight was helpful and it helps you trading tomorrow. Risk on, risk off, wax on, wax off. Goodbye.